The broadcast is now starting. All attendees are in listen-only mode.
Welcome to our Outlook 2020 webinar. We're glad that you joined us today. We've been hosting our Outlook event for a number of years. This becomes our signature conversation regarding our outlook for the markets, financial planning strategies, and passing on information to you so that you're well equipped for the year ahead with your financial plan. We're excited today to have a special guest, Dr. Antony Davies, who will be speaking in a few moments. Also, Jim Long, our Director of Investments, Julie Hall, Wealth Advisor and Director of Financial Planning, will be speaking. And our agenda today is Jim and Julie will be giving a brief overview of some of the things going on in the financial markets and in financial planning strategies and an update to tax law change. Then we'll be transitioning to Professor Davies for an in-depth discussion around the issue of government debt and some of the things that he has brought to light through his research and ongoing commentary. I want to invite you to submit questions along the way. You'll see on your computer screen that there's a place where you can submit questions, and at the end of our program, we'll have a dedicated session to review your questions and continue the discussion. So without further ado, I'd like to turn it over to Jim Long, who will be giving us a recap of 2019 and what's ahead in 2020.
And thanks, Nathan, and thanks to everyone for joining today. It's great to be with you. Think about where we were 14 months ago at the end of 2018. We had just come through a 20% market decline associated with several Federal Reserve short-term interest rate hikes, and the results of the election in 2018 led to a divided government. All of these things encompassed together kind of made you think this isn't the greatest opportunity for outstanding market class or asset class returns in 2017 or 2019. But what did happen? We did have outstanding market performance in 2019. Sustained economic growth, the Federal Reserve reversed their course and actually cut short-term interest rates without a corresponding spike in inflation. And by any measure, the U.S. economy stayed really solid in 2019. And this led to outstanding performance across classes. U.S. stocks up over 30%, developed and emerging markets, international stocks up 20% and more, and bonds and other asset classes up across the board. We expand out, so from 2009 to 2019, the chart that we show on the graph here, a trend that I always like to identify for folks is this move away from active investing towards passive investing. And what do those terms mean? So active investing, you're trying to beat a market index, generally a little bit costlier expense. Passive is you're trying to match index performance and typically at a much lower expense. So this chart will show you the red is U.S. stock investments coming out of actively managed strategies. So the red is $2 trillion over the past 10 years have come out of actively managed U.S. stock funds. Some of that money goes into investors' pockets to use for other things. Some of that money goes to invest in other asset classes. But the green and the blue positive is $1.5 trillion that in aggregate has gone into U.S. passive stock funds. So this trend is something I always identify. We at Planning Alternatives have stayed on the forefront of this over the last 7 years, where we've transitioned our stock portfolio from more actively based mutual funds to passive based exchange traded funds. If we zoom out even a little bit further, we look at the last 19 years from 2000 to 2019. This is showing the performance of the S&P 500 or the 500 largest US based stocks versus a diversified portfolio of investments, your traditional 60-40 portfolio comprised of U.S. and international stocks, small size stocks, and bonds of various flavors. So for the first 2 years of this sample time frame, the S&P actually went down significantly, the diversified portfolio down, but not quite as much, but still as an investor, I'm angry because I lost money in my portfolio. The next few years, the S&P 500 recovers pretty nicely. The diversified mix of funds also recovers, but not as much. I'm angry because I didn't earn as much as the S&P 500. You fast forward down to the bottom, and for this nearly 19-year time slice, the S&P 500 up over 211%, and the diversified portfolio up over 213, leading to the tagline that diversification wins even when along the way it feels like you're losing. So this leads nicely into the set of philosophies that we use to build portfolios for clients. First off, we want to give you exposure to lots of different assets. So not just stocks, not just bonds, not just alternative strategies. We want to build a portfolio amongst all these asset classes. And within those, we want to practice global diversification, not just US, not just developed markets, not just emerging, but encompassing all of those. Julie will talk about planning in a second, but we want to manage the risk of your portfolio and marry that with a financial plan that helps you meet your goals and objectives with the least amount of risk necessary. And then finally, we want to have this lens of cost sensitivity in building portfolios. Not that it's the sole determining factor of choosing an investment, but we want to pick sets of investments and always have this in the background of thinking, can we do this in a more cost-effective manner for our clients? We transition to 2020 and what our expectations are for the US economy. Unemployment still low. I made the slide before the most recent uptick in unemployment, but that's for a good reason, because more people are entering the workforce. And even though you had the unemployment rate go up by 0.1% last week, it's because people are entering this workforce looking for a job. We've got low inflation still. Federal Reserve policy probably going to maintain unchanged for the rest of the year. All of these things together, very solid for the US economy. And you marry that with a consumer segment in the US that's just in excellent shape. And the proof point is on the next slide from our friends at JP Morgan. On the left-hand side, you'll see a couple of stacked bar charts. The biggest one is our assets as US consumers, homes, investment accounts, cars, all these sorts of things, $130 trillion of assets. The smaller stacked bar are all our liabilities, home notes, car notes, credit debt, 16 trillion. And that'll lead to the bottom right, which is household net worth in the US of 115, 116 trillion dollars, all-time high, very much stronger position than we found ourselves in 2007, 2008. And the top right, as another proof point, the debt service, which is your household disposable income, what percent of that goes towards debt service and paying off all those debts? It peaked at between 13 and 14% around the last recession. We're under 10 now. So inevitably, whenever that next recession does occur, I believe that we're better positioned to withstand it. And all of this financial strength for the consumer continues to lead the US markets higher. What are some things that could upset this? Obviously, trade has been on the hot topic for the last year and a half. We have this first faith agreement between China and the US recently. I find it hard to believe we'll have a second phase before the election timeframe. And of course, China has their hands full with the virus outbreak. But the key thing to keep in mind for this year is how the US, the United Kingdom, and the Eurozone will kind of deal with each other, and how that all gets thrown in the pot, and we figure out how that the trade relationship is going to be balanced there. Does the US go and do a bilateral agreement with the UK first, or do we deal with the Eurozone? How do the UK and the Eurozone deal with each other? If that gets down towards the end of the year and the deadlines that have been established, I think you could see volatility spike up a little bit. US elections, just to go back for a second. So US elections 2020, anybody that's got a TV or radio has seen all the ads. I think the conventional wisdom is that the president is slightly favored for re-election. The Senate and House slightly favored to remain in where they are now, albeit maybe with some reduced majorities. I think this leads to divided government again. So you're thinking maybe things like the US-Mexico-Canada agreement passed with broad bipartisan support, the Secure Act that Julie will mention in the next minute or two. These sorts of things moving forward, maybe rather than broad sweeping legislation. And finally, the things that we can't foresee, whether it's a virus outbreak or an Iranian general getting bombed, all these things that we can't necessarily foresee, but if we build a strong enough portfolio, we can withstand all these things. In summary, 2019, excellent returns across classes. 2020, maybe temper the expectations a little bit, probably not a 30% year for US stocks, but as long as the economy remains strong and the consumer strength high, I think we probably have good returns. Risks are always going to be surrounding us no matter what, and even things we can't foresee. So in light of all this, what do? We want clients to remain diversified across and within asset classes. we recommend clients meet with their advisors to review not only their ability to take risks, but their willingness, and see if that's changed. And if we have things coming up, if you have needs for cash in 2020, we want to make sure that we have that money on the side right now. Markets at all-time highs. It's good to take a little bit off the table and put that money aside for the needs that you may have in 2020. So with that, we'll turn it over to Julie for a discussion on the Secure Act.
All right, thank you, Jim. Well, in May of last year, everybody thought the Secure Act was going to pass. And as the year progressed, nobody thought it was going to pass. And then right at the end of the year, it passed, and it was signed into law on December 20th, 2019. So many people have asked, what does SECURE actually stand for? And it stands for Setting Every Community Up for Retirement Enhancement. So why this retirement reform? According to the U.S. Census Bureau, in 2035, older adults are projected to outnumber children for the first time in U.S. history. So we've got an aging population that's living longer, and on average, when we look at America as a whole, not saving enough to fund a 30-year plus retirement. Now, there were a lot of changes that came with the Secure Act, and if we tried to cover them all, we'd be here and well past dinner. So we're not going to do that, and we don't want to put you to sleep either. So we're going to focus on 3 key areas of change. Key change number 1, and that's the death of the stretch. So what does that mean exactly? Well, prior to the passing of the law, when a non-spousal beneficiary inherited a retirement account, they were required to take a minimum distribution from that account over their life expectancy. So allowing them to stretch the income from this inherited account over their life expectancy, allowing greater tax deferral. The new law requires that the account must be emptied by the end of the 10th year following the year of inheritance. And that is for some beneficiaries, non-spouse beneficiaries of some retirement accounts. There are some exceptions to this rule, and those are for eligible designated beneficiaries, also referred to as EDBs. And those EDBs are spouses, disabled individuals, chronically ill individuals, minor children of the account owner until they reach the age of majority, any beneficiary not more than 10 years younger than the account owner, and some trusts that are set up for the beneficiaries that are eligible, the EDBs we just discussed. All right, let's move on to key change number 2, and that is the change to the required minimum distribution start age. So the RMD start age used to be age 70 and a half, and now that is changed for individuals who turn 72 in 2020 or later. So if you turned 70 and a half prior to 2020, guess what? It's business as usual for you. If you were turning 70 and a half this year or next year and you don't need the funds, this is going to allow for greater tax deferral for a longer period of time. And if you were implementing any type of Roth conversion strategy, this is going to give you a little more time to be able to do that. Now let's move on to key change number 3. And we actually combined several changes into one here because they all point to the same theme, and that is to encourage more retirement savings. So if you look at bullet point number 1, there is the elimination of age limits for traditional IRA contributions. So prior to the new law, when you reached age 70 and a half, you could no longer contribute to a traditional IRA. Those restrictions are now gone, as long as you have earned income, and of course it makes sense with your plan. The next 2 items, some increase to tax benefits and some new tax benefits for small businesses who implement a retirement plan, and a retirement plan that has an automatic enrollment option. Again, encouraging savings. If you look at the very last item on the list here, elimination of 401k loans made via credit cards. If you didn't know that was a thing, neither did we. It's a good thing that that is being eliminated because your 401k should not be an ATM.
Thank you, Julie. We're going to transition to our special guest, Dr. Antony Davies is the Milton Friedman Distinguished Fellow at FEE, the Foundation for Economic Freedom, Associate Professor of Economics at Duquesne University, and co-host of the podcast Words and Numbers. Dr. Davies authors monthly columns on economics and public policy for the Philadelphia Inquirer and Pittsburgh Tribune Review. He has written a book on understanding statistics, published by the Cato Institute, has co-authored hundreds of op-eds for, amongst others, Wall Street Journal, Los Angeles Times, Washington Post. His YouTube videos on economics, government, and policy have garnered millions of views. And in fact, that is how I became introduced to Professor Davies. Thankfully, a client sent a video on a very important topic to me and our firm surrounding government debt. And I was surprised when I saw that there were over 1.7 million views of this video when I was expecting about 17 views on the video. So it was engaging, and thanks to Sarah Eaker on our team for reaching out to Dr. Davies. In addition to his work, Dr. Davies was associate producer at the Moving Pictures Institute, chief financial officer of Paramount Computation, founded several technology companies as a co-founder and chief academic officer at Freedom Trust, where he lectures on economics for high school students across the country. So welcome, Dr. Davies, and we are going to turn it over to you so that you can share from your computer the presentation regarding the federal fiscal mess as you adequately and accurately present it. So welcome.
Thank you. Thank you, Nathan. So I'll be talking about the coming federal fiscal mess. And to begin, I want to put our current fiscal problem in context. If we think about how much the federal government owes, we'll call this roughly obligations, and we can compare this to other countries' economies for a sense of scale. The debt held by the public, this is money that the federal government owes outside of itself. So this is not including, for example, money it has borrowed from the Social Security Trust Fund. That's $17 trillion, or about the size of China's economy. If we add in what's called intragovernmental debt, which is mostly money the federal government has borrowed from the Social Security Trust Fund, we get public debt outstanding. This is the official debt of 23 trillion, and that's about as large as the US economy. But there's more. There's federal agency and government-sponsored enterprise debt that doesn't show up on the government's books. However, the federal government is responsible for this. We add that in, and what we get is effective federal debt of 31 trillion. That's about the size of US, Japan, and Germany's economies combined. But then the fun goes on, because we also have what's called unfunded liabilities. This is money the federal government has promised, typically in the form of Social Security and Medicare, Medicaid payments. It's money the federal government has promised to current and future retirees that it does not and will not, under current law, have the money to pay. And if we add that in, we get total federal liabilities, the total amount of money the federal government either officially owes or has promised and will not have the money to pay, of about $130 trillion. And for perspective, that's the size of the entire world's economy, plus another United States, China, Japan, and Germany. Now, of course, the federal government has income, which it uses to help service this debt, and we can put that in perspective as well. I'm sorry, and by the way, I've left out here, $8 trillion in state and local debt and unfunded obligations, and if you care about that, you can throw in an extra United Kingdom, France, and Italy economies for that. In total, the federal government's revenues are about the size of India's economy. And that's the money the federal government has available for servicing this debt. If you don't like those numbers, we can knock it down a little bit further. And the federal government's financial obligations is like a $75,000 income household having a $3 million credit balance, debit balance on its credit card. So what are the implications of this massive debt? Well, here's our total federal liabilities of 130 trillion. Currently, the federal government pays 2.5% interest on its debt. Now, keep in mind here, the interest rate that the federal government is currently paying is the lowest it has ever been in the history of the United States, and this is because the Federal Reserve has been holding interest rates low. But nonetheless, at this historically low interest rate, do the math, and the federal government would have to set aside $3.4 trillion each year, not to pay off its obligations, but simply to service the interest on those obligations. And herein lies the problem. The federal government's annual federal revenues are 3.5 trillion. So in other words, to service the liabilities that the federal government currently has and balance its budget would require cutting federal spending across the board by about 90%. So that's what we look like now. What's the future of the federal government's finances look like? The Congressional Budget Office is one of a couple of entities charged with projecting the future of the federal fisc, and they come out periodically with forecasts. So let's see what they have to say. Their data currently goes back to 1997. So in 1997, the CBO forecast the economy and the federal budget for the next decade. And we have these forecasts, and they did this in 1997. They repeated it in 1998. They repeated it in 1999. Every single year up to the current 2019. We have all of these things. If you add them all up, we have in our possession a total of 187 forecasts that CBO has made that we can compare to what actually happened. So here I am standing post 2007, for example, looking back at the forecasts that the CBO made, and I can compare these forecasts to what actually happened. And of course, in some years, CBO's forecast will be a bit low. In other years, CBO's forecast will be a bit high. But if CBO's forecasts are unbiased, we should expect that roughly half the time their forecasts will be too high and the other half of the time they'll be too low. Well, it turns out if you look at CBO's historic forecasts, 80% of the time they over forecast federal tax revenues. And 60% of the time they under forecast federal spending. So historically, CBO's forecasts have been painting too rosy a picture of the government's future in both directions. So the question then is, well, by how much? How bad is this over and under prediction that CBO is committing? Here I'm showing you the average numbers, and again, this is historic CBO's forecast going back to from 1997 up to the future. On average, when CBO is forecasting 1 year out, it tends to overpredict federal revenues by about 1%. When it forecasts 2 years out, it tends to overpredict federal revenues by about 6%. 3 years out, it overpredicts federal revenues by 9%, and you can see the pattern here. By the time you get to a 10-year forecast horizon, CBO on average is forecasting federal revenues that are 25% higher than what they actually end up being. Meanwhile, on the federal spending side, you can see on average, the CBO underpredicts federal spending all the way through, and you get this same phenomenon. The further out into the future you go, the worse this bias becomes. So when we're talking about a 10-year forecast, generally speaking, when CBO says the federal government will get X amount of revenues, they're 25% too rosy. And when they say that federal government will spend Y amount of dollars, they're about 11% too rosy there. And here you see why politicians, perhaps over the past couple of years, have started to talk about the effects of their policies in decades. So they'll say things like, well, this bill, if it's passed, it will generate X billions of dollars over the next 10 years, or it will cost so much over the next 10 years. Well, they're getting their projections from CBO, which of course is biased in the rosy direction on both sides. So what's interesting here is if we know that CBO is producing these biased forecasts, and we know on average by how much they're biased, can we adjust them? In January 2020, CBO predicted that by 2029, federal tax revenues would be $5.6 trillion. Now, we know that CBO overpredicts revenues. If we adjust this prediction by their historic bias, what we find is that we can probably expect 2029 federal revenues to be closer to about $4.5 trillion. Also, CBO is projecting that federal spending in 2029 will be $7 trillion. We know that that's a low ball estimate. If we adjust it by CBO's historical bias, we find that actual federal spending in 2029 will likely be about $7.8 trillion. Now, currently, CBO is projecting that by 2029, we're going to have a deficit of $1.4 trillion. If you use these adjusted estimates that I've just shown you, you find that the actual deficit in 2029 is likely to be over $3 trillion. Now, you might say to yourself, well, that can't be right. The government has been talking about trillion-dollar deficits, a $3 trillion deficit. That's 3 times what we're talking about here. Let me put this in perspective. In 2009, CBO looked forward and it projected that the deficit in 2019 would be $235 billion. The correct answer was $984 billion. CBO was off by 400% in predicting today's deficit. And these larger deficits add up, of course, to larger debt. Currently, CBO is projecting that by 2029, the federal government's official debt, so this is not counting these unfunded obligations, is going to be about $35 trillion. If we adjust for CBO's historic error, we can actually expect that this will be around $56 trillion, the amount of money the federal government will officially owe. If we add in unfunded liabilities, which by that point could be as high as $250 trillion, we're now looking at an amount of money that we're looking at the federal government owing an amount of money that far exceeds the economic output of the entire planet. Now, of course, again, at a visceral level, you can say, well, that just simply can't be right. Who would ever believe a $56 trillion deficit? Well, again, some perspective. In 2009, the debt was $12 trillion. CBO projected that by 2019, the debt would rise to $16 trillion. Well, it turns out that we crossed that $16 trillion mark all the way back in 2012, just 3 years after CBO had made its prediction. By the time we got to 2019, the debt was $23 trillion. So CBO was off by almost 50% in its estimate of what this future debt would be. So this is not a very pretty picture, but it raises the reasonable question, can the economy sustain a debt like that? What you're looking at here is the federal debt, the official debt, as a fraction of GDP, going back to 1947. And of course, you can see as we went through the recovery from World War II, the economy grew and we paid down some of this debt. And so the government's debt as a fraction of GDP fell. Then we get into the Reagan deficits. We come to the period of the Clinton budget, which was, people say Clinton had budget surpluses. He actually didn't. There wasn't some accounting stuff going on in the background, but he came closer than any modern president to balancing the budget, almost had surpluses. So, but his budgets combined with the dot-com boom, we had a decline in the federal debt as a fraction of GDP. It rises again in the wake of the Great Recession and all of the stimulus spending. And here we have CBO's projections. CBO projects that the debt as a fraction of GDP will follow this pattern over the next decade. Now, a couple of things to think about. One, as of right now, our economy is supporting a government debt level that was last seen at the close of World War II. So you follow all of this business about the war bonds and your victory gardens and all of this and loan your money to the federal government so it can execute World War II. All of that debt, that is the same amount of debt as a fraction of our economy that we're experiencing right now. If we look at CBO's projections, CBO is projecting that about by 2025 or so, the debt level in this country will reach the level that it reached in Greece when it became apparent that Greece was going to go bankrupt. Now, that's CBO's projections. That's the adjusted CBO projections. If we adjust for CBO's prior biases, we can actually expect our debt as a fraction of GDP to look something like this. And you can see that by 2029, we're approaching 200%. There's only one country in, as far as I know, the history of modern humans that has ever approached this level, and that's Japan. All right, so who's going to loan the government this much money? Now, this is an interesting question. I mentioned Japan. This is not a question Japan had to deal with. Of course, Japan's debt is on the order of 200% of its GDP. But bear in mind, Japan is an economy that's roughly the size of California plus Texas plus a little bit more. So when you've got an economy that size, floating in the ocean of the rest of the world, there's plenty of money there for Japan to turn and borrow. Now, I'm not saying it's necessarily a good idea for Japan to do so, but the money is there. When we're talking about the United States, we're talking about a country that is, whose economy is so large, the federal spending is so huge, we already owe so much that we're approaching a point where quite literally there's no one left on the planet from whom to borrow. So let me put this in perspective. Currently, the official holders of the official federal debt, American investors hold about 35%. Foreign investors hold about 30% of the official federal debt. The Social Security Trust Fund holds another 25%. And then finally, the Federal Reserve holds about 10% of the federal debt. Now let's look at what happens over time. This is the Social Security Trust Fund, how much federal debt it holds as a fraction of the economy. And you can see that the numbers rising from the 1980s up through about 2010, and then it starts to decline. That decline is under current law will continue. It will continue all the way down to zero, because starting in 2010, the Social Security Trust Fund started paying out more than it's bringing in. It's anticipated that that will continue for the foreseeable future. So as time goes by, not only does the Social Security Trust Fund no longer have surpluses it can loan to the federal government, rather it needs to call back money that it had previously owed, had previously loaned to the federal government so that it can make good on Social Security retirement payments. So bottom line here, don't look to Social Security for a place to borrow money. How about foreign investors? They've turned around since about 2012 as well. They're down about 10%. Largely speaking, our largest creditor is China, which since about this time, 2010 to 2012, has been cutting back on the amount that it loans the federal government. Put these two together, that's 55% of federal government's debt holders have actually been scaling back on how much they lend the federal government. Here's American investors. Now they've been chugging right along, loaning more and more to the federal government. We're up 65% since 2013. What's remarkable about this is we seem to be at a historic high. Now these numbers only go back to 1970. It may have been a bit higher as you go back to World War II, but at least in modern times, this is about a historic high. The question here is this something we can expect to continue? How much more will American investors be willing to lend to the federal government, given that they've already lent so much, and given the fact that the interest return on federal debt, the Federal Reserve is holding at historically low levels? So here we have, of our 4 sources of funds, 3 of them are largely maxed out. And that leaves only one place left that the federal government can turn to borrow money, and that's the Federal Reserve. If American investors, foreign investors, the Social Security Trust Fund, if they just held steady, the Fed would need to loan an additional $25 trillion to the federal government over the next decade. What has happened here is over the past several decades, the federal government has borrowed so much money, it has painted the Federal Reserve into a corner. The Federal Reserve is going to be forced to monetize part of this debt. because there is no place left for the federal government to borrow more money. What happens if the Fed loans the government another $25 trillion? Well, the money supply right now is about $4 trillion. And if the Fed lends another 25 trillion, if you do the money multiplier thing that economists do, the reasonable estimate is that we would see an increase in the money supply over the next decade of about $30 trillion. Now, what that means is that's about the equivalent of sustained 20% inflation. So let me say this in easier language. If it is the case that the federal government continues spending at the rate it has been, and if it is the case that American investors, the Social Security Trust Fund, foreign investors are largely tapped out, they cannot loan more, that means the Federal Reserve is going to have to take up the slack by purchasing the federal debt. And if it does that, we can expect about a 20% annual inflation rate for the foreseeable future. Now, you might ask, well, or are there alternatives to printing all of this money? Well, we can talk about raising taxes. I should be more specific here. Raising tax rates. It turns out the federal government can't raise taxes. It can only raise tax rates. Taxes are what happens when you combine tax rates with economic behavior. The two come together and generate some tax revenue. That becomes important for what I'm about to show you. What you're going to see here are federal tax revenues from 1946 up to the present. Now, over this period, 1946 to the present, payroll tax rates have ranged from a low of 1% to a current high of about 15%, counting employer and employee sides together. The top individual income tax rate has ranged over this period from a low of 28% to a high of about 92%. The effective corporate tax rate, so by effective, what I mean is the actual tax rate that corporations pay, not the statutory rate. So after they do the accounting and legal gymnastics and all the dust settles and you ask the question, what fraction of your income did you pay? This is the number. It's ranged from a low of 20% to a high of 45%. Capital gains tax rates have ranged over this period from a low of 15% to a high of 40%. The estate tax rate has ranged from a low of 0% to a high of 77%. And look at this interesting line. This is what I like to call the most interesting graph in economics. And it's interesting precisely because it's so boring. This is just a horizontal line running from 1946 to 2018. This is the federal tax revenue, all sources combined, income taxes, capital gains taxes, tariffs, everything. Federal tax revenues as a fraction of GDP. And what you can see is from 1946 to the present, it's hovered rather tightly around 17%. It doesn't matter whether we tax the rich more, we tax them less. It doesn't matter whether we tax people or we tax corporations. It doesn't matter whether we raise tariffs or tax estates. It historically has not mattered what the federal government has done. They're destined to collect a relatively constant 17% of GDP. Now, we can do an entire other episode on why that's the case, and I'm not entirely sure myself. I have some ideas, but the fact is this has been the case. And what it means is raising taxes simply isn't going to work because the federal government's tax revenue seems to be dictated by GDP, not by the tax rates that the federal government sets. What about cutting spending? Well, we need to cut $1 trillion. This is $1 trillion each year just to stop this problem from getting worse. This doesn't solve the problem. It doesn't pay off any of these debts. It just stops the bleeding. Can we cut $1 trillion? Well, here's the 2020 budget highlights. You see discretionary spending of 1.5 trillion. Most of that's the military. You see mandatory spending of 3 trillion. The bulk of that is Social Security. To cut $1 trillion from the deficit would require, if you want to leave mandatory spending alone, would require cutting discretionary spending by 50%, 50. Now, as you think about this number, remember that this past summer, Rand Paul suggested cuts to the budget, and he was laughed on all sides, saying that this was ridiculous, what he was discussing. It would never go through politically. It wouldn't last. In fact, it didn't even come out of committee in the Senate. His suggestion was to cut 2% from the budget. Just to stop our current problem from getting worse, we'd have to cut 50% of discretionary spending. So what can we expect moving forward? At some point over the next 10 to 15 years, we're going to see cuts to Social Security. It will likely come in the form of means testing. You'll start to hear politicians say things like, well, some of you out there are fortunate enough to have employers who contribute to a pension or employers who contribute to 401k plans. And you're fortunate to have that because you got college educations, which enabled you to get good, well-paying jobs. And how did you get those college educations? Well, you got them because the federal government subsidized your loans. It's time for you to give back. And the way you're going to give back is by having cuts to your Social Security benefits. Now, politicians will phrase this in all sorts of language that implies equity and justice. What they're actually doing is reneging on financial obligations. They promised people that if you paid X dollars into Social Security, when you retire, you'll get Y dollars back. And now they're going to come back on that deal and say, no, we're not going to do this. Some other things we're going to see, I would anticipate, is a removal of the Social Security tax cap. You already hear politicians talking about this a lot. And this is, I think, a horrible idea. And it's a horrible idea on several fronts. One is the Social Security tax cap right now is around $137,000. It's right at the point that you find many households in which the income earners have regular jobs and they have side businesses to augment their incomes. Many people like that are able to grow these side businesses to actually become standalone businesses, which then start to employ other people. So what you see is there's this interesting class of entrepreneurs in this economy, particularly now as we talk about the gig economy, that rely on a regular employer while they get their business going and then transition to their business. Removing the tax cap on Social Security will be like slapping a 15% tax on these entrepreneurs. If there's one group of people in this economy we should not be imposing more taxes on, it's the people who are on the verge of creating new jobs for the rest of us. Another couple of problems, politicians find a way to spend whatever extra money they get. If we remove this Social Security tax cap, and politicians will tell us we're going to remove this so that we can solve all these problems that I've been showing you thus far, I guarantee you the very next budget, politicians are going to start arguing about how they should increase spending because they now have this extra money coming in. And if you look historically, you find that that's the case every time over the past 50 years that the federal government's revenues have gone up by $1. The next budget spending goes up by $1.25. The politicians find a way not only to spend the extra money coming in, but to use it as justification for spending still more. And of course, we're going to see monetization. There's no way around this. The Federal Reserve, to a greater or lesser degree, will monetize some of this debt service. And you see it already. When we talked about quantitative easing, this was the Federal Reserve printing money to fund federal government spending. You hear it now with this rise of MMT, modern monetary theory. And I'll tell you as an economist, modern monetary theory is a fringe idea. Economists generally, not all of us, of course, but generally economists tend not to take it very seriously because what it is simply printing money. It has lots of words attached to it, but basically it's printing money and using this for federal government spending. But what we're finding is, and you found a similar phenomenon with the Keynesian revolution, politicians grabbing onto this and using it as academic justification for what they want to do. In the case of Keynesian economics, it was, we want academic justification for increased government spending. And here we find politicians using this as academic justification for printing more money. So that's the state of the world from my perspective. If you've liked this stuff, I'll take this opportunity to give a shameless plug to my podcast, Words and Numbers. You can find us at wordsandnumbers.org. We come out every week and we talk about things like this. So if you'd like this, please join us. Nathan, thank you for this opportunity.
Thank you, Dr. Davies. We'll invite guests to continue to contribute questions as they're accumulating. We also want to let you know that we're available to continue the conversation on a personal basis so that you can have a conversation with your advisor and your advisory team and know that we're working together, building a plan for you and having things in good order. So, Dr. Davies, some of the questions are around, thank you for bringing this to light. So what? What can we expect going forward? And in our world, we're helping people make decisions on an individual basis about how to build a plan that includes forecasting their future, managing their investments, looking at tax planning, estate planning. What is the takeaway that you would pass on to our listeners as it relates to the so what for them?
Yeah, that's a really good question, because there's some good news here that I didn't mention. And the good news is all of this horribleness we've talked about here, it's all on the financial side. It's not on the goods and services side. It's not on the production side. So in other words, none of this that I've talked about reduces the amount of physical capital we have. It doesn't reduce our technology. It doesn't reduce our educated labor force. All of the things we have that we use to produce goods and services remain in play. What changes is people's expectations. People expected to get Social Security payments, they're not going to get them. Or people expected inflation to be a certain level, it's not going to be. And what that means is the way to deal with this is careful planning. It's possible to work your way through to protect your assets and so forth, but all of this is going to happen on the financial side. It's not going to happen on what we call the real side, the actual goods and services. And so careful risk management, careful financial planning is the key to weathering this as best as possible.
So if we drill into that by applying a portfolio strategy, and we discussed this off camera pre-webinar, what does that mean from a type of investment standpoint? So do we purchase real estate buildings in our towns? Do we store cash under our mattress? Do we buy gold? Do we invest into whatever category we might think is appropriate? And Jim, I'll ask for any perspective you have. How do these issues ripple to the portfolio strategy that we're implementing for our clients?
Well, as I mentioned before, we certainly still practice the preaching of concept of using different asset classes. Some maybe are better positioned to deal with some of the challenges that Dr. Davies had mentioned, but I still think now we have access to stocks, we have some exposure to bonds, we have exposure to other asset classes that don't move in concert with stocks and bonds. We marry this with a financial plan that Julie constructs so that we try and give you the diversification you need to meet your goals and objectives. But as those goals and objectives might change because of the information presented today and other things that come down the pike, we can adjust our portfolio and utilize other things as necessary to change an expected amount of return necessary if Social Security doesn't make up as much of your goals and objectives, or if a pension doesn't come to fruition as much as you may think it might. We can constantly update and revise the plan and choose different investments to meet your goals and objectives as necessary.
Yeah, I think that's absolutely right. I have to preface by saying I'm not a financial planner, so don't put any credence in anything I'm about to say, right? But some reasonable things are to have a more international focus, look beyond the United States, also stay as diversified as possible. It's not entirely clear. Some sectors are going to be hit by what's coming more than others. Some will actually prosper. And it's not clear to me, it's probably more clear to you people, what those sectors will be. But a diversification strategy and carefully monitoring your portfolios seems to me to be reasonable.
And I would think that there's going to be more emphasis on equities perhaps over time, in the sense that if the government is going to be printing money, creating inflation, not that that's the only theme for the future, but that seems to be a directional expected outcome. Historically, equities have been one of the best vehicles to have an opportunity to outpace inflation. While it may feel good to have all your money in your savings account at the bank, earning 0.2%, when inflation is at 2 or 3%, you're consistently losing money, even though you may feel secure by having no volatility, no change in, or minimal change in the account balance on your statements. So it poses challenges, which is the nature of what we help our clients do, which is to figure out what are your personal needs, how do we build an effective financial plan that looks at all the issues with open eyes and builds a risk management strategy. We would also caution our audience against some of the industry's products that are being pushed. That would be the cure-all for all your woes. Buy this product and you don't have to worry about anything. When in fact, many of those products are laden with fees and lack of liquidity and extended commitments on a time period of holding that. So we encourage people to, our clients and guests on this webinar, to continue to stay educated. We're here to help you every step of the way.
I'll draw an analogy as well. I agree with your statement about equities. And people have this psychological tendency when they see the stock market drop to get out. Don't do that. When it drops, that's the time to get in. There are plenty of economists who've looked back at the Great Depression, the stock market crash in 1929. If people had only bought in 1929, by 1939, they would have been immensely wealthy. Exactly.
To share a Buffettism, be greedy when others are fearful, and fearful when others are greedy.
Right.
We have a question related, Julie, to the Secure Act. What should people do given this change? Do they need to update anything in their estate plan, or what do you see what would you recommend as the next step in light of the Secure Act?
Yeah, so we recommend that you do sit down with your estate planning attorney and your advisor early on this year, especially if the beneficiary of your retirement accounts is your trust. And we actually did put together a case study, which we did not have time to cover today. So if you'd like to see that, that's something that we could send out to you. But we do, again, recommend that you meet with your estate planning attorney, with your advisor, and review your estate plan and your beneficiary designations.
Thank you, Julie. Dr. Davies, a question related to what's happening in the U.S. relative to the rest of the world. So you give a great presentation, a great argument about the underpinnings of the deficit and where we're headed. We see and hear about this. You referred to Greece, you referred to Japan. The question is, are we the next Venezuela? And where there's just been complete restructure. What's your perspective on that?
Yeah, I don't think we're the next Venezuela, but 1/4 of Venezuela, perhaps. Venezuela has other problems beyond what the monetization. We are, in a lot of ways, we're the prettiest country at the ugly country ball, right? The European Union suffers from tremendous regulatory and taxation burdens that we don't have here. If those things went away, the EU could become an economic juggernaut. China suffers from lack of market freedoms. If those went away, China would become an economic juggernaut, and both of those things would be excellent for us. But I don't see them happening in the near future. So as bad as things are here, I think in a lot of ways, with maybe a few exceptions here and there, Switzerland is one, in a lot of ways, this is as good as it gets right now on planet Earth.
Jim, if you wouldn't mind sharing perspective about our international exposure, which as we look forward into expected returns, what we see there.
Like I mentioned before, one of our key tenets is to have the global diversification. So we do have exposure to not only developed international markets, but emerging markets. I think the story there is the population growth is happening in these countries. The technological advances are faster paced there, and these things combine to possibly give the growth outlook on a little higher trajectory or higher plane for these types of places versus the developed markets of old school Europe, the United States, even Japan, and even China with some of the issues with their population growth too. So some of these things together, I think makes it so that we've got some exposure to these international countries and that hopefully this expanded growth can pull up some of these places. And that's why we continue to rely on some exposure there.
Well, it looks like that is it for our scheduled time. We thank everyone for participating. Dr. Davies, thank you so much for being part of our Outlook 2020. You were so kind to create a video that we shared at our Michigan and Naples and Sarasota, Florida Outlook, so well received, really stimulated a lot of discussion. And we've recorded this webinar, so we'll be sharing that through different channels as well. Thank you. And as Dr. Davies mentioned, his podcast, Words and Numbers. I know that you have a book, Dr. Davies. Do you mind just mentioning?
We have a book, Cooperation and Coercion, which is coming out at the end of March. You can pre-order on Amazon. It talks about a lot of things we're talking about here.
Thank you. So thanks to everyone, and have a great day.
Thank you.